Good day, everybody. Hope you're doing well. I'm here with Adrian Day up in Quebec for the mining conference. Adrian, how are you doing today?
I'm doing fine, thank you.
That's good to hear. So, Adrian, we just saw your talk here when you were giving the presentation to the audience about opportunities in the commodity space. Obviously, you started the presentation about the gold sector, but then you moved on quickly to talk about copper and a few other things. What would you think is important for investors to know about the demand for copper and also the supply side at the moment?
Yeah. Okay, well, before we get to that, may I just, point out that typically in commodity cycles tend to be very long, but typically in commodity cycles, gold will lead at the beginning of a cycle and gold will lead at the end of a cycle. But in the middle, which is where we are now, in the middle of a cycle, gold will tend to lag and other things do well. And looking at the various commodities, I think, virtually all of the commodities are going to move up over the next 3 to 5 years, including the agricultural commodities. But I think one of the leaders, one of the best investments will be copper. And the reason I say that is even though people say, well, copper's lagged, what do you mean? Copper's at all-time highs. Yes, copper's at all-time highs, but if you look at copper relative to gold, it has still lagged for the past 3 years. Why do I think copper is going to be is a good investment right now? One of the things that's very special about copper, not unique to copper, but certainly different from gold, is the long lead times to get a project into production. So even once the board of directors has made a decision to go ahead with a project, it's still typically a minimum of 5 years before it starts producing. And so what that means is that we have very good visibility on what production is likely to be 5 years from now. Even if there's a brand new huge discovery made that we don't know about at this point, it's not going to be producing for 5 years. And so we can look with relative accuracy at the potential cap on production in 5 years' time. If you look at what, Wood Mackenzie, S&P Intelligence, all the firms that study this in detail, when you look at what they're looking at for production estimates for the next 5 to 10 years, and then you look at the demand estimates for the next 5 to 10 years, you see that there is a gap and a growing gap which can only be met by higher prices. And I made the point in my talk this morning, when we talk about demand, a lot of people talk about AI demand being a driver of copper demand. And there's no question that with AI data centers, you do need more copper, not just for the data center, but also for the wire to bring the power into the data center. No question about that. And some people have said, well, they think that the AI projections are overblown. Cut those back, then maybe copper demand doesn't look as strong as it otherwise would. The interesting thing, if you look at, I'm quoting S&P Intelligence now, Global Intelligence, their estimate for 2040, so we're talking 14 years from now, their estimate for 2040 is that AI will account for only 3% of total global demand. So the growth in AI is important for copper. Copper is important for the growth in AI, but it is not the driver of the growth in demand for copper. So long story short, best projections we have, conservative projections on demand, conservative projections on supply, and we simply do not have enough copper to meet the demand.
Right, so even if some investors who are nervous about the AI bubble popping, even that wouldn't be enough to deter the demand for copper moving forward.
Correct.
Yeah,
correct.
Okay. And just in talking about the general market here, I mean, the S&P 500 just seems to keep marching up no matter what the news is with the Middle East. What do you think about the rapid increase of the S&P at the moment?
No, that's interesting. It's a very, very narrow group of stocks that is leading the S&P. If you look this week, the S&P's made new highs, and yet only 6% of the stocks in the S&P have also made a new high. And when you have a strong bull market, you should have much greater breadth. More stocks should be participating. And you've had days where you have more 52-week lows than 52-week highs. But we all know that it's a very narrow group of stocks that is leading it. That, of course, was true 3 months ago and 6 months ago. So it's a question of how long does it go on before something happens. To me, and I've said this before, to me, being an investment advisor, or in fact just being an investor, is not really a matter of trying to make predictions about what's going to happen. So making a prediction about when the S&P is going to pop and break is fun, but that's not really the point of investment advising. The point is to look at where we are right now, look at all the factors on one side of the equation, all the factors on the other side of the equation, and based on where we are now, what is the risk and what is the potential? And right now, notwithstanding that the S&P could continue to go up for the next 6 months, but right now there's simply a lot of risk in the market with such a narrow group of stocks leading the market, and with the market trading at all-time highs, or multiple highs, valuation highs.
I know very few investors tend to look globally in the United States. I know you're a lot more attracted to those markets right now. Can you tell the audience a little bit about why that is?
Yeah, you typically the outperformance and underperformance of global stocks, or not global, foreign stocks, non-US stocks versus the US market, but performance and underperformance tends to go in long waves. So we have just come off, at the beginning of last year, was like 13 years of US market outperforming foreign markets by a growing amount. And at the beginning of last year, foreign markets were at their lowest ever relative valuation to the US market. And everything I'm saying now is relative. Right, last year the foreign markets outperformed the US by almost 2 to 1. But even so, they are still at 50-year relative lows. And the foreign markets would have to go up 20% a year for the next 5 years for that relative valuation to return to the last cycle low. That just shows you how dramatically undervalued the foreign markets are relative to the US market. So these cycles tend to move in, they tend to be long. As I said, 13 years the US market was outperformed. Before that it was about 8 years when the foreign markets outperformed, and then before that about another 8 years when the US market outperformed. But if you go back to the end of the Second World War, so we're talking 70 years, you find that in fact foreign markets outperform the US exactly the same number of years that the US outperformed foreign markets. So I just think we're due for, just on that basis alone, we are due for a multi-year period when foreign markets outperform the US. Now then, if you add to that the relative valuations, foreign markets are much less expensive than the US, and particularly the smaller markets, what used to be called emerging markets, much less undervalued than the US. The economies are doing well. And typically, painting with a very broad brush here, if you have a period of dollar decline, which it seems as though we've been in for 12 months until the war, and then we'll probably resume that period afterwards, but if you have a period of dollar weakness and global inflation, then smaller markets, emerging markets, tend to outperform developed markets, and particularly outperform the US.
I mean, we seem to be alone in this view, Adrian. I mean, at this mining conference and the last few we've been to, I think we're the only investment advisors here that deal with a retail audience. What has to happen for the average investment advisor who recommends the S&P 500 and says things like it's not timing the market, it's timing the market? When are they going to change it and start to diversify their clients out?
Well, I think they're going to change after the foreign markets outperform for 2 or 3 years, and that's always the case. I mean, I think you need the S&P to go down for 3-6 months, and for people to look at their statement every month and see a lower number, not a higher number, and year-to-date negative returns, and then the investor starts calling the investment advisor and saying, hey, this isn't working, what should we do? And they might go into commodities, they might go into gold stocks, oil stocks, they might go into value investing, they might go into foreign markets, but all the sectors and markets that have lagged and underperformed, they'll jump on the next one that's moving up.
And I know we've spoken about gold mining stocks being quite cheap for some time now. One of the good slides you had in your presentations that got a breath from the audience here in Canada was the relative valuation of ASX gold mining stocks versus the Canadian ones. Do you mind talking a little bit about that?
Well, very briefly. I mean, looking at it on a very simplistic, and this is very simplistic, please understand, I understand that. But just very simplistically, Australia produces about 50% more gold than Canada, and the Canadian gold stocks are valued at almost twice as much in aggregate as the Australian stocks. Now, of course, the big caveat there is that a company in Canada might be producing from Mexico and Burkina Faso and so on, but so too are the Australian companies. So it's not meant to be in any way a scientific value, but it just shows you the wide gap. But then if you go and look at valuations, and this, on the slide I had up, I had enterprise value to EBITDA, EBITDA.
Keep it simple, I think.
Yeah, but you see that Australian stocks are trading at far lower valuations to their worth, to their net worth, than our Canadian stocks.
Yeah.
Now, as I mentioned, I think the Canadian stocks are still cheap, but the Australian stocks are much cheaper on a relative basis, and that's often the case until you get well into a bull market with retail participation. So once we get to the next phase of this gold bull market, when it's not just central banks and Tether and a few high net worth individuals who are buying, but it reaches into the retail audience, into the generalist audience, that's when the Australian stocks begin to really catch up.
Yes, I think it's going to be interesting. I know we're looking more and more at some of the Australian miners at this point here and looking to accumulate some of them. The last thing I wanted to ask you about to do with your presentation was the oil market. I know you showed that chart of the oil stocks versus the S&P 500 since the war broke out, and everyone was shocked to see that the S&P was actually doing better than oil stocks. Can you tell the audience a little bit about what's going on with oil stocks?
Well, if you look at the oil stocks in isolation, of course, they've done well in the last 5 months. They started prior to the bombing of Iran, but they've done well, obviously, with the rise in the price of oil. But again, lagging the S&P. I think people are still fundamentally nervous, cautious, if not downright hostile to oil. And look, the plain fact is, you can like it or not like it. I won't get into that argument now. But the plain fact is the modern industrial society cannot operate without fossil fuels. Right now, there is no alternative. Uranium is an alternative, but that's going to take many, many years to build out sufficient plants to replace. Even if it eventually does replace, it probably won't replace. It'll probably, be another contributor. But even if we're looking at it replacing, it will be many years, much more than a decade. And so, for the foreseeable future, fossil fuels are required, and that includes coal. Frankly, in North America and Europe, people don't like coal. But since the bombing started in Iran and the Straits of Hormuz was closed, really interesting demand for and investment in coal in not just China, but China and Vietnam and Thailand and Malaysia and Indonesia and Japan, which is a clean air society. It's gone up because they realize for a dependable source of energy, coal coal ranks very high on that criterion. Of course, it emits CO2, but if you're looking for a dependable supply of energy, coal is part of the answer. But certainly, oil and gas are part of the answer, and they're not going away anytime soon.
I know the audience won't forgive me if I don't ask about uranium as well. I know for a while the uranium valuations, especially of the juniors, were looking a little bit pricey. How do you feel about the uranium market now?
Yeah, I mean, if I take a 5 or 10 year view, I'm very bullish on uranium. I think for the next sort of 5 years, you're going to have steady increases in the price of uranium, but nothing outstanding. So looking at it on a 10 or 20 year basis, just keeping up with inflation, basically. We forget that a lot of these commodities have actually lagged just inflation adjusted prices. I think some of the uranium stocks, frankly, remain overvalued and are not really fully where investors are assuming that a lot of projects are going to be built, but maybe are not going to be built because they're marginal.
It's interesting to see. Right now, the market's pricing the gold mining stocks as if everything's going to go wrong with getting the mine in production, and then with uranium, it's the opposite. Everything's blue sky.
I think that's right,
Yeah.
but I would certainly hang on to core positions in uranium and look for opportunities to add.
Wonderful. All right. Well, thanks, Adrian. I know you've got a panel coming up, so I don't want to keep you for that. Thanks for joining us, and we'll catch you later.
Thank you very much, everyone. Thank you, Mark.